Welcome. We are going to be continuing with this new format not only for our weekly email communications, but also with this video. Now, we would love to hear your feedback on this new format, if it's going to be one that we want to be continuing or not. And remember, your input is invaluable to us because we want to be sure that we're providing you with the best content and transparency as possible. So today we're going to be addressing some differences with respect to the economic conditions and stock market risks that are out there. And we're going to be also mindful of the fact that we are going to be having some changes in the portfolio that are coming. And then lastly, we'll be talking about some advanced planning. And this is going to be with respect to your estate plan. So let's jump right in. Economic and stock market risks. There has been a lot that has been changing over the past week, and let's take a look at some of the different details that are going into the financial landscape. Interest rate hikes are the first part of this. Now, the Federal Reserve recently raised interest rates and has indicated the possibility of even 1 to 2 more hikes to come. Now, these changes can significantly impact the market and your investment strategies. Inverted bond yield curve. The next one we are looking at is the continuation of an inverted bond yield curve. Now, why we are looking at this is because history has shown that inverted bond yield curve has really forecasted recessions with 100% accuracy. Now, this indicator currently raises concerns about potential economic challenges that are ahead. But not to be outdone, there is a fear of missing out. Now, right now we are witnessing an unprecedented amount of fear of missing out in the stock market. Now, with a massive influx of money into stocks, this is heightening the sentiment just surrounding that and really could lead to some market volatility in the future. But right now, this has not been the case. We have had very low volatility and we have a continuation of an increase of the stock market. Now, again, this can change at any time, and with the fear of missing out, there are many elements that we need to be considering. On the other hand, Japan's economy has been doing very well, but now their stock market is actually going to be improving with their economy. But here's the aspect of Japan that has changed over the last week: yield curve control with Japan. Now, what's really started to happen here is that they're departing from their yield curve control and potentially selling US bonds, and what this could really do is drive the yields up and then impact the prices of our own bonds here. But there's one problem with the Japanese yield curve control. It's our own bonds here that we've been really talking about, and right now the Treasuries has a reliance on short-term issuance of bonds to fund our government, and this may create an additional hardship after the election. Their servicing our national debt will become more significant part of our budget. Now, this has changed from over the last number of years where we've gone more long-term dated bonds. So what this could be is something that we are having more on the short-term basis, and we will be funding the government at a higher interest rate and maybe more potential for hardships in the future. But even as we're talking about bonds, there was actually a surprise. There was economic growth that happened in the second quarter. So what ended up happening was that we had been forecasting really no growth for the second quarter, but there was a slight uptick in the second quarter's growth, primarily due to the government spending. And really this compared to previous quarters, and every other element of the GDP was flat. But government growth really came in strong to propel us in the second quarter for growth. Now, there's one concern that we're starting to look at more and more: inflation. Now, I've been talking about inflation for a while now, and yes, it has been falling. We are now reaching a point, though, where the sustaining of this decline has become more challenging, and the greater risk lies in the potential for a meaningful inflationary pressure, not only the weeks, but possibly the months and quarters to come. So this is a change from just even a couple weeks ago, and it's something we are monitoring very closely. That leads us to our next segment: portfolio changes. Okay, now with everything that is being highlighted here, with all of the economic growth and risks that are out there, we really want to make sure that we can secure your future with respect to how we work with your investments. And here are some strategic changes to your portfolios that we are considering and making it for the future. The first change that we have been talking about and really implementing over the course of the last couple of months is avoiding traditional bonds. Now, like I said before, with all of the different hardships that bonds are facing recently, it is something that with the recent rate hikes, we're currently not really looking to invest into bonds as they stand right now, and because their returns might not be as good going forward and really might be affected by the increase of our interest rate hikes as well as what's going on with Japan. The next one that we have been talking about is investing in commodities. Now, really to counter the inflation, commodities are a good place to be, and increasing the investment in commodities is something that has tended historically to perform well during inflationary periods. So it's not to say that we're going to be going all in on commodities, but it's definitely something that as we start seeing these changes happen and commodities start to grow, we will be right there to look to add them to your portfolio. Now, the last element with inflation that we want to be talking about are healthcare companies. Now, we're going to be adding in over the course of time healthcare company stocks to your portfolios. Now, these companies possess positive pricing power and allows them to adjust their prices to keep up with inflation. And that leads us to the wealth management and advanced planning. Now, today we are actually going to be talking about a couple different elements of your estate plan. Now, it is becoming increasingly important that we talk about this now because of all of the tax changes that are potential to come with the sunset of the Tax Cut and Jobs Act at the end of 2025. Now, here's the thing, and here's what I really want to be talking to you about, that some action with your estate plan is better than none. You see, it really doesn't matter how wealthy you are. It's our nature as humans that we put off sometimes these important matters, whether it's because we don't have time or sometimes we don't want to spend the money. But what makes tax sense versus what makes sense psychologically for you may not always align. And that's where we step in here at Lions Wealth, as well as your estate planning specialists. And we can help you focus on meeting your goals with respect to your estate plan. Now, whether you have a lot of money and consider yourself very wealthy, or we have a lot of money that has been set aside in your retirement accounts over your working career, what we really want to do is max out your exemptions. And we want to maintain this level that we don't have to give up the control to taxes or even giving up your wealth. And we really want to maintain a relatively small portion that would be going into the taxation from the government. So what this looks like then is that we really want your family to be set up for the long term. Now, we have another election that's coming up as well in 2024, and it's now theoretically possible that Democrats could increase the majority in the Senate and take back the House. And what this would mean for you, possibly, is that we could possibly want to be comfortable with wishful thinking here that the sunsetting of the Tax Cut and Jobs Act won't come. But really what happens is that since the Democratic leaders have already proposed eliminating the tax cut loopholes for the rich, that may never be the case, and we need to be prepared for that. So what we know, what's available today. Now, we don't know that some of these techniques are going to be around for much longer. And that's where we really want to be making the changes of potentially what's to come with the lowering of taxation with respect to the brackets, as well as your estate taxes as well. All right, well, that was really the gist of a lot of the elements that we're looking at today. Now, with this, we also have what we call a second opinion, and we would like to remind you of that service that we offer for your friends and family. Now, these are ones who can benefit from a professional review of your wealth plan. Please let us know if you have anyone that would like to go through a second opinion of their wealth, and we can be providing some crucial details on gaps that exist. Your financial success is our top priority, and we are committed to guiding you through these challenging times. And if you have any questions or need assistance, feel free to reach out, and we'd be happy to talk not only about your investments, but also your advanced plan, making sure that you have the best possible wealth plan that we can be producing over the course of time to make sure that you are going to have the highest probability of success.